In today's video, we're going to go through and take a look at how much rising interest rates could affect you at renewal, including if you have a fixed rate and a variable rate. And we're going to jump into the financial system review from the Bank of Canada, where they go through exactly how much interest rates could increase based on their projections. Oh, and on top of that, I'm going to talk about how I was wrong recently in one of my videos with respect to when you should buy a home. So stay tuned till the end of the video for that. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky winner is going to win $5,000, and we are going to give that money away on July 1st. All you have to do to enter is go to 360giveaway.ca, fill out the form there, and make sure you're subscribed to this channel. And by the way, if you follow me on Instagram or if you share the contest on social media, you get another entry into that draw. So again, go to 360giveaway.ca. Okay, so let's jump straight into it. Today, we're going to discuss, like I said, the effects of higher interest rates at renewal. And there's some really interesting data that was in the financial system review from the Bank of Canada that I want to point out because some of it has some real validity to it. Some has some errors in the assumptions that were made, but I want to go through and just talk about where Canadians sit right now with respect to their mortgages and how that could look 3 to 5 years down the road when those mortgages come up for renewal. So let's jump into this. And let's start first and foremost with this. This is one of my favorite charts from the Bank of Canada's financial system review. And what this shows is the percentage of people who have a mortgage versus the percentage of people that don't versus the percentage of people who are renters. So what this shows us is that 37% of Canadians right now, 37% of households are renters. So about 2/3 are not. And of those 2/3, there is a pretty significant amount that, surprisingly to me, actually don't have mortgages. So of the households in Canada, 28% own and don't have a mortgage. And then of the rest, 35% of households have an actual mortgage. And then when we break this down even further, of those 35%, well, 25% of households carry fixed rate mortgages and 10% carry variable rate mortgages. And then what's not surprising to me is when we start to get into the breakdown of the variable rate mortgage products, which some people are saying are one of the biggest risks to the economy right now. I don't necessarily agree. I still think there is a case to be made for variable rates. But what's interesting is that fixed payment mortgages make up 80% of the variable rate mortgages in Canada, and only 2% have adjustable payments. Now, it's my belief that if you are in a mortgage that is a variable rate, in fact, it's my belief for the most part that most people should be taking adjustable rate mortgages so that over time, interest rate fluctuations are felt gradually as they happen. Because the reality of it is that a 5-year fixed mortgage is really not a 5-year fixed mortgage. It's a 5-year adjustable mortgage where the payments adjust every 5 years. And it's interesting to note that the Bank of Canada has gone in and calculated what the exposure is for those people with 5-year fixed mortgages at renewal because of their adjustability. So, really interesting stats here, really interesting information. And where it gets even more interesting is when we start going into the Bank of Canada's projections with respect to what increased payments should look like. Now, there's a couple of flaws in the data that I'm about to show you, at least in my opinion. First and foremost is that they are showing that mortgages will renew at median rates of 4.4 and 4.5% respectively. This is for variable rate at 4.4 and fixed rates at 4.5. Now, for the most part, 90% of the time or 80% of the time, whatever it is, a large majority of the time, fixed rates and variable rates aren't this close together. So saying that we're going to assume 4.4 for variables and 4.5 for fixed doesn't make sense. There should be a wider gap between those two interest rates. So this is the first flaw that I see in the numbers that they show here, because at some point, if somebody is renewing and they have the option of a fixed rate or a variable rate, there's a high likelihood that there's going to be a wide gap between those two interest rates. So if fixed rates are at 4.5, my guess is that variable rates will be somewhere around 4%, maybe even as low as 3.5%. The other issue that I have with this is it's not an apples to apples comparison. So I want to point that out right away, because what they point out is that many people who took variable rates took significantly larger mortgages. So that is valid from the perspective of the distribution of mortgages, but it's not valid from the perspective of the increased payments. But the insights here, even though the data, in my opinion, isn't necessarily super accurate and super fair from a variable versus fixed perspective, is actually really interesting. And it's something that Canadians should be taking note of. So this is what the numbers look like and how it plays out. And what this is this is a chart of the potential increases in payments that could happen for Canadians if interest rates were to continue to go up in the next 3 to 5 years and people were to find themselves paying higher interest rates at renewal. So first and foremost, let's take a look at the all mortgages originated in 2020, 2021 category. What they're saying here is that of all of these mortgages, on average, people can expect about a 30% increase in payments at renewal if interest rates go up to that 4.5% range and stay there. Now, for high loan to income ratio, these are people who took substantially larger mortgages than the average. Their potential exposure at renewal is about a 37% increase in payments. Now, as we get into the fixed rate mortgages, what you can see is that the picture here is painted significantly differently. Now, they're showing that the increase for fixed rate mortgages would be about 24% for all mortgages on average. And for those high loan to income ratio, those super big mortgages, it's going to be about a 26% increase. But here's where it gets really interesting, because at the bottom here where it says variable rate mortgages, it shows that the increase in payments will be about 44% to 45%. Now, here's where this math gets tricky. Here's where the data gets tricky, because what you have to understand is that the people who took variable rate mortgages back in 2020 and 2021 started with significantly lower payments in a lot of cases because they had significantly higher discounts. And yes, while those interest rates have increased quite substantially and will continue to increase quite substantially, the payment factor that they've used here of a 44 to a 45% increase is based on the fact that they think that the variable and the fixed rates are going to be pretty much at par when renewal happens, which is probably not the case. And you also have to account for the fact that I'm estimating, or I'm guessing, that they base these variable rate payments based on the fact that certain mortgages are going to re-amortize at some point, meaning that if you've been paying more interest than principal and your amortization has been increasing over and above the contract term that you should be having, well, then there's a high likelihood that you're going to end up in a situation where your payments are going to go up substantially more because you didn't have those adjustable payments that adjusted over time and kept the amortization at what it should be. So, really interesting here, but the moral of the story is this. Most people who took a variable rate mortgage started with a lower payment. And yes, if interest rates go up to 4.4%, as the Bank of Canada is suggesting, then you're going to see about a 44 to 45% increase in your payments. But again, that variable rate shouldn't be at par to what fixed rates are. So the chances of it being quite as bad as what this is saying are less likely than what this is trying to make it out to be. Now, on top of that, the increase to payments is inevitable, which is why we've always suggested that adjustable rate mortgage, which adjusts as interest rates start to go up and makes it so you feel the pain gradually rather than all at once. And yes, we're feeling a little bit more pain right now because we've seen this super jump in the last month and this super jump that's coming in the next month. But after that, it should start to level out. And at some point, there is going to be a time where interest rates do start to come back down. It might be in the near future. It might be in the long term. It's hard to tell. It looks more like it'll be a longer road than a shorter road. But at the end of the day, if you stick with a variable rate strategy over the long term, the statistics and the data show us that over time, you will do better than trying to time the market by jumping in and out of a fixed rate mortgage. So, it's really interesting here. And it's really interesting from the perspective of the fact that the Bank of Canada is suggesting that there's going to be about 2% more in interest rate increases to get us above that neutral point of 3.5%, which means that even today, if you were to choose a variable rate mortgage at 2.7%, the likelihood of that variable rate mortgage getting above where interest rates are expected to go is still unlikely. So there's still a pretty significant case to be made for variable rate mortgages, along with the fact that those fixed rate mortgages, especially if interest rates do start to go down at some point, are going to have substantial penalties associated with them. And they can become a pretty significant set of handcuffs for you if you need to make a move or need to change something. And on top of that, we know that 3 out of 5 Canadians don't make it to the end of their 5-year term. In fact, we looked back at our book of business from the last 5 years, and our book of business has pretty much turned over about every 3 years. And that is very much in line with the statistics that we get from Mortgage Professionals Canada and different institutions throughout the industry. Now, with respect to the mistake that I made on Wednesday on my video, I put forth an example of why you should be trying to get a lower interest rate and not necessarily waiting for the market to correct, because the lower interest rate over time will have a substantial benefit to your total borrowing costs. And there were some very astute commenters in the comment section that were absolutely right in pointing out that if housing prices were to go down by 6%, even if you ended up paying 1% more for your mortgage, you would have a lower balance owing at the end of 5 years. And they suggested that given the option between purchasing now or waiting 6 months, that in 5 years when those two mortgages come up for renewal, even if one was 1% higher than the other, there's a really good chance that you are going to renew at pretty similar interest rates 5 years down the road. And in theory, they are absolutely right about that. But the point I was trying to make in that video was not necessarily that you should be trying to time the market. In fact, the point I was making was that you shouldn't be trying to time the market, because in the event that the market doesn't fall, you aren't going to be able to benefit from that lower house price while also being exposed to those higher interest rates. So what we've always suggested to people, and this is the same way that we suggest variable rates over fixed rates, is we always suggest that you want to get into the market at your earliest opportunity when the rates are the lowest. And over time, if you can get into the market when rates are lower and pay lower interest rates while your mortgages are bigger, then over time, you should fare better than somebody who waits and tries to time the market. Because the reality of it is this, is human beings are horrible at timing the market. If they were good at timing the market, we wouldn't see investors jumping into the market in February trying to buy at the top of the market thinking that they were going to do really, really well, which they didn't. And what I want to show you here is a really interesting heat map, because this is a heat map with respect to the price exuberance in Canada. And here's the reality of it is, if you are purchasing in markets that are in the red zone here, so this is red light, green light, really simple to understand, well, your market's probably going to have a bigger downturn than some of the other markets. But if you're purchasing in the green markets, what that means is that your market isn't necessarily in a position where the prices are overly exuberant. And what that means is that they may not fall at all. So if you're waiting based on the national statistics, which is housing prices are going down by 20 or 30%, and really what they're talking about is Vancouver and Toronto, and you're waiting to get into the market in Calgary or Winnipeg or Victoria or Quebec City, well, what you're waiting for is a crash that may not come in that market. So what you should be doing is looking to that earliest opportunity to purchase at and get a mortgage that you are comfortable with. You don't want to be one of those super high income to loan borrowers, but you want to have a mortgage that you are completely comfortable with paying for the long term. And if you can get into those markets now while interest rates are low, you're probably going to fare better than if you're waiting for a crash that may not come. So this is all about certainty. And the certainty is this: right now, you know you can get a mortgage that's lower than what it's going to be a year or 2 years or 3 years down the road. And the uncertainty is what's actually going to happen in the real estate market, because nobody thought when the pandemic happened that we were going to see a run up in housing prices, when the exact opposite should have occurred when everybody basically lost their jobs and didn't have the money in theory to purchase homes. So what I was trying to get across on Wednesday was simply this: purchase when you have the earliest opportunity so that you have certainty around your interest rates. I'm not necessarily suggesting you take a fixed rate over a variable, but you can with certainty borrow now for a lower rate than what you will be in the next little while. Housing prices, on the other hand, there is no certainty here, especially in those green markets. That is to say that you will get a better deal somewhere down the road. You're waiting for something that you expect to happen, but that may not necessarily happen. And yes, in theory, the same thing could happen for interest rates, although I don't think that's necessarily in the cards. But after a few months here, what we could see in areas like Toronto and Vancouver is we could see the market start to settle down and that crash that was expected not actually happen. Now, it could happen as well, but if you're buying for the long term with long-term decision making rather than short-term decision making, 25 years from now, a crash in the market or a correction in the market will just be a blip on the radar. So if you found this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that 360 giveaway contest and a link to the video from Wednesday right here. Cheers.